Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking about gold continuing to hold over 2100 and the stocks, how they are still very much disconnected from that stronger gold price, as well as some of the unfortunate operating issues that we have seen, both geopolitical and from an operating front in the sector, as we are chatting with John Rubino. You can follow John over at his Substack account, which we will link to below. John, first things first, we've talked about this concept of the gold equities underperforming the gold price for quite a while now, well over a year, as gold has continued to hold up near all-time highs and most recently is at all-time highs or hit all-time highs and is holding above 2100. But the gold stocks, well, we have seen some life, some larger volume come into some of the majors, even into the ETFs. Man, oh man, those stocks are still not even close to 52-week highs, let alone all-time highs. What's going on here, John? Why is there this big disconnect?
Hey, Corey. Hey, Shad. Yeah, it's been how many years that we've been saying, as soon as gold starts to really move, the miners will just take off, and they'll start outperforming the metal because that's how it works. Not so far, though, this time around. Gold at 2150 in the US. That should just light a fire under the gold mining sector, and it has not happened yet. I think, and I don't know for a fact because I thought they'd be rocking right now, but I think there are some explanations for that. And one is that once people change their mind about something, it takes a really long time to change it back. So it could be that people just don't trust the gold breakout and they don't trust the miners in any event. And so we need more from gold. In other words, gold has to go to 22 or 2300 and then people will start paying attention and getting excited. That's a possibility. The other is that mining has become an incredibly tough business lately. It's always a tough business. But lately, some big, scary things have been happening that kind of shake people's confidence in the concept of miners. The Cobre Panama thing, where Panama just shut down one of the world's biggest copper miners out of the blue. They had already re-upped its contract, and it looked like it had another 20 years to go before there were any regulatory issues. And then, boom, it just gets shut down. That was existential for First Quantum, which owns and operates the mine. And it was pretty traumatic for Franco-Nevada, which had tossed over $1 billion at streaming contracts on that mine. So it was pretty serious. And if you were watching what happened to those two companies, it's understandable that you're going to be a little bit nervous about the sector now, because who knows what else is going to happen. Like, Mexico's president proposed a ban on open pit mining. So, there's a lot of potential geopolitical stuff out there that, it's always been an issue for miners in the past, but it's a much bigger issue right now. And that's probably holding back a lot of people's enthusiasm about the precious metals miners now, because they don't know, whether the kind of mine that miner operates is going to be made illegal or something like that, or some other new thing is going to come along. So that's an issue. So we kind of need some placid geopolitical time to help people forget about Cobre Panama and what the Mexican president said and everything, because they're still negotiating the Cobre Panama thing. And it's possible that they find a way to change the terms of the deal that allows the mine to keep operating, which would be huge for First Quantum, and it would be a big pop for Franco-Nevada if that happens. So that's, it's possible. They're in negotiations, and that mine was like 4% of the Panamanian government's tax revenue. So there's an incentive from that corner to get a deal done and get that mine operating again. So that would help. But, it is what it is right now. The world is different, and mining is a tougher business. So I think we need pricing in the underlying metals that allow for serious cash flow. And really, today's price is pretty good. If gold stays where it is right now, this year, the big miners in general will report a lot of positive year-over-year comparisons. So we've kind of got that going for us. And, that might be enough. Maybe a couple of like 30 or 40% increases in free cash flow from some of these companies. And all of a sudden people get excited. So we'll have to see, but it is a bit disappointing that we're not in a rocking mining stock bull market right now.
Well, John, there are a lot of factors that play into why the mining stocks may be underperforming in a big way compared to the metals price. You bring up an interesting topic here, and you'd mentioned it kind of quipped off Mike, is this going to be something where the mining stocks are seen as toxic investments, too toxic to invest in, or is it a contrarian opportunity to really buy value? But when you think about the Cobre Panama situation you outlined, or when you think about the Mexican potential to ban open pit mining, it's not in isolation. There's been coups in some of the African countries. There was the coup in Niger that really riled the uranium stocks there. There have been issues where there was militant groups that actually kidnapped some mining executives in a couple West African countries. So it's not that mining is easy. And then if you think about permitting, you could have permitting challenges in the United States. You could have permitting challenges in Canada and what are considered good provinces or states, and they still have challenges. Is it a tough sector for generals to get their head around because there's just so much to know and weigh on the risk factor compared to like a retail big box store investing in that? There's such a different list of potential problems that could befall a mining company compared to most companies.
Yeah. And, add that to the fact that, leave geopolitics aside for a second and just look at mining operations. The big miners basically defy analysis in any event because they've got, 10 or 15 mines in multiple countries. And every mine is unique in terms of its operating challenges. And every country is going through something, and if you forced me to sit down and come up with a valuation for Newmont, I would be completely unable to do it, because it would be just too many different moving parts, all of which involve assumptions, right? And so it's a very tough analytical challenge. So what you need for the miners to be interesting investments to people who actually want to dig in and understand what they're buying, you need positive trends where, okay, Newmont has all these different mines, but most of them are generating increasing free cash flow, and overall, they're paying off their debt and they're raising their dividend. If stuff like that is going on, you don't need to know the details of every single mine in every single country. And I think that's a challenge right now because we don't have that massive uptrend in cash flow yet. If we get it, then we can overlook a lot of the crazy stuff that's going on in the mining industry. But if not, then the whole geopolitical thing looms really large. But, I think in the end, the toxic versus historic bargain thing will be resolved in favor of historic bargains. These things are just extremely cheap, the mining stocks, relative to the underlying commodity and relative to the big stock indexes. So they're, as Rick Rule would put it, they're hated. And he loves hate, right? And so they're in that kind of a category right now of things that it's terrifying to buy in, but 5 years later, you look back and wish you'd had bought in. Now, Stanley Druckenmiller, who's a big mainstream money manager, just did something like that. He sold some tech stocks and he bought some Barrick stock. Now, what we need is a few more big names doing something like that to give everybody else permission to overlook the scary stuff in the mining sector right now and focus on future cash flows. And I think that's going to happen too. I'm still pretty optimistic about the sector. It's just that it's taking way longer to work out in a positive way than seemed likely.
Oh, it definitely is. Like I said, we've been talking about this for a while. But, John, not to oversimplify it, but when you look at equities in any sector, you can have income stocks, ones that pay dividends, and you can have growth stocks. And much of this sector, the precious metals sector, they don't really compete dividend-wise with other sectors out there. So then these companies need to show growth, but outside of better margins, thanks to a higher gold price, do you think we actually need these majors back out there doing stuff, back out there trying to grow through acquisition, through what have you, any way that they can grow rather than sit passively by and say, well, when the gold price goes up, well, then we're going to do better?
Well, rising cash flow solves that problem, first of all, because if you give these guys a bunch of extra cash, they're going to do exciting things, right? They're going to raise their dividends. They're going to make big acquisitions. They're going to pay off their debt. And that's the kind of thing you can sell, because like you said, a dividend play is inherently interesting to a big chunk of the investment community. And, with the kind of margins they should generate with gold at, let's say, $2,200 an ounce US, that should produce nice dividend increases, which show up on the screens of dividend players, right? It should. So that could be the thing that's let gold stay where it is, and then all the stuff we're talking about is kind of baked into the cake. But until the miners, based on what they're seeing with their own financials, are confident enough that it's got some staying power and everything, then they're not going to be aggressive about share buybacks or dividend increases or anything like that. But let them be confident, and all of a sudden you'll see, because there's it's kind of a coiled spring kind of thing with dividend increases and share buybacks, that you don't do it, you don't do it, you don't do it, and then once there's the cash to do it, you make up for lost time. So I think that could be the environment going forward. And meanwhile, there is one ray of light here, and that is the current financing situation for explorers and other kinds of juniors is brutal. Nobody wants to lend these guys money, which means the big, or not just the big, but all of the royalty companies that have access to capital have a pretty good environment for doing deals, because they might be the only option for a lot of these little miners and explorers. And that means that the Franco-Nevadas of the world get to cut some really nice deals right now. And when the market turns, that generates a lot of cash flow for them, even compared to their previous deals, just because they did the new deals in such a favorable environment. And that should make the royalty companies in general relatively attractive in this space, because they don't care what Mexico does necessarily, unless they shut down one of their mines, or something like that. But most of the operating issues that affect miners are relatively minor for the royalty companies, because they're diversified. Franco-Nevada has 400 properties or something like that, and the majority of them aren't even producers yet. So they've got a lot of growth built in based on their previous deals. And that's the kind of thing that in a rising metals price environment could look really exciting. It's possible to run some numbers that make those stocks look much more valuable than they are. So that's one sector of the precious metals industry that is actually reasonably good now. The Cobre Panama thing really hurt, but generally, as diversified as they are, and based on the fact that most of them choose the best quality jurisdictions, a lot of them are in Canada and the US, which so far at least is an okay place to have a mine. So they're undervalued along with everything else, but it's less justified in their case, and I think they'll do really well going forward. And then all these troubles in the mining industry kind of point you, more strongly than normally towards the physical ETFs, right? If the Cobre Panama was actually a great thing for, if there was a copper physical ETF, that would have been a good thing because it raised the price of copper. So mining geopolitical trouble is actually helpful for the gold and silver physical ETFs. So that's a thing to look at and hide out in. If you still like precious metals, but you're worried about all the other stuff that's going on, just go buy PSLV or something like that, a physical silver ETF, and just hold the ounces in Sprott's vault, and ride this out. So to simplify everything, sum up, there's a couple of sectors that still look good right this minute. And the other parts of the precious metals industry ought to be okay. But right now, there's a lot of complexity out there that has people spooked.
Well, John, just following up on the comment about the royalty companies, you and I have talked about them quite a bit over the last couple of years, but there is 3 different ways they generate royalties. One is the prospect generator model, where they're optioning the properties out and eventually convert it to a royalty. One is going out and bidding on a royalty, which can be very competitive and can sometimes be very pricey now. And they run the risk of overpaying for a royalty that takes them too long to pay back. But there's this other way, which is basically creating a royalty, which is lending a company money, an explorer, a developer, or even a producing company money for some aspect of their development or moving a project along, and then they pick up the royalty. When you say it's a good time for the royalty companies, is that third way the way you're kind of looking at, that they can offer the money now because they're more cashed up to help a struggling sector that doesn't have a good access to capital move their projects along and pick up royalties they normally couldn't do in a better market. Is that the way you're looking at it?
Well, yeah, there are a lot of explorers out there that, they've got a property, it looks pretty good, but there's this much drilling that still has to be done before they can really firm up the estimates and everything and know what they've got. And they're out of money. Where do they get the money? Eloro is a pretty good example of this because they've got a really extensive property in Bolivia that's taking a really long time to drill so that they can go to a big miner and say, look, we've definitely got this here. Do you want to buy us out? So they're not there yet, but they have payments that they're contracted to make as part of the process that they're in there. And they just renegotiated some of those payments, okay, which is a sign of weakness as far as that goes. But the stock, the stock price went up on that because at least it relieved some of the pressure. But then they just announced that they're going to do a stock offering in order to raise the money for the next payment that's coming up. And the investors did not like that at all. The stock tanked. And so that's the kind of situation that a lot of these explorers are in. They've got legit properties that are going to be worth a lot at some point, but they have to get from here to there. And that's where a royalty company can step in and say, yeah, okay, let's create a royalty or a stream based on what might happen in the future, based on what we've seen, and we'll pay you this much. And then the explorer says, oh, is this what I have to do to survive? Okay, I guess I'll sign on the dotted line, and then, so it's not a great deal for the explorer, except in the sense that it allows them to survive till they get to the point where Newmont comes in and buys them out at a nice premium, right? And that's the situation that's out there for a lot of these guys, which is a pretty good situation for the royalty companies who have cash to throw at things like this. So, yeah, I would expect that the best funded royalty companies are going to announce a lot of deals in the coming year just because the market's pretty ripe for stuff like that. And a lot of them will be where you create the royalty. And as somebody who owns a lot of the explorer stocks, I'm kind of torn by this, but if it keeps them going to the point where they pay off, then okay, that's just how it has to be. We got to get through this valley before we go on to the next peak. But this kind of valley is actually very good for the royalty companies because it lets them cut some favorable deals.
Oh, there are definitely opportunities out there for companies with money, royalty companies, and even these producers to go make some acquisitions. Or, as you said, they're pretty much just keep the lights on type of money for some of these companies. Problem being, there's such a wide variety of these companies that need cash. So all these companies, we need to see more money spent within the sector. It's not coming from outside investment, so it needs to come from inside the sector. And it's been kind of slow. These majors have been very restrictive with their cash, building cash balances, but not utilizing it yet. We'll see if that all changes. But John, hopefully we're not talking about the same concept at the end of the year, even into next year. It's still early on this year. Hopefully this little turn that we have seen here really lights a fire under some of the capital flows in the sector and brings in some more capital as well. John, thank you as always for your time. Remember, you can follow John on his Substack, which is linked below, and we'll chat with John in another couple weeks. Thanks for your time, John.
Thanks, guys. See you soon.